Hello, everyone. Hello, Warriors. I'm Dale Pinker with TradeGATEHub.com, and it's great to have Adam Button with us today to talk about the whole gamut. We'll cover the board with you guys. Great to have you back, Adam. Last time we talked, we were going into April. So I'm going to start off with the elephant in the room, and I'm glad this happened. The seasonals were very constructive for risk in April, right?
It's the best month of the year, historically.
Okay. And it turned out to be, I mean, look, we're breaking back into this megaphone. April was a lousy month with follow through in May. It teaches us that it's just a tool, right?
Yeah.
Seasonals are just another tool, just like everything else we have in our tool chest to diagnose markets and not to rely on any one thing for major decisions. May give you a bias, right?
I mean, we say that almost every time, right? It's one tool in the toolbox. You want it to all align, right? That's when the great trades come, when you see the technical, seasonals, fundamentals all start to come together. And it's just a fundamental story right now with inflation and central banks falling behind.
Yeah, and pretty negative. I think 3,800, 3,850. A lot of people are talking about in the S&P. Believe that would be 38% back from the COVID low to up here. I think it could be even deeper. Some of these moving averages, since we've taken out, these are monthlies.
I find it interesting right now. The psychology is changing, right? You hear people talk, okay, it was a tech bubble, right? There's sort of this resignation now that it was a ridiculous bubble, kind of like a 2001 style bubble. Right. Everybody's getting carried out on that side. Yeah. And then the future is very unclear at the same time in terms of rates and where they'll be. So you have a huge deleveraging, difficult to step in front of. And you just kind of bring all that together, and what's the bottom? You start to crunch something like Disney yesterday reported earnings. You say, well, Disney, one of the greatest brands in the world, has some streaming platform, pretty good numbers on that, and yet it's still trading pretty rich. And if you think, well, we might have high rates, maybe a recession, then you're still not there, even though it's been more than cut in half from where it was at the peak. So
yeah, it's not even isolated to risk and equities. Have you noticed, and I know you have, and there's a term called it's all one market, and that the markets all pretty much go up and down together. It's a matter of magnitude. And basically what is up. So S&Ps are down. Silver took out an important low here, and gold is down pretty good, $200 from the high, and the dollar keeps marching. The only change I've seen, I want to know if you agree with me, maybe markets take longer than us to wake up to it, but it looks like the 10-year yield
bit of a turn in bonds.
That it turned pretty good.
Yeah, well, I mean, it looks small in the shape of that, but yeah, we're down to 286 from 320 at the highs.
Yeah, so that's 45 bips.
And dollar yen falling with that. Actually, just writing about Barclays, it's been 9 weeks in a row higher in dollar yen. That's an insane run. And and you talk about all trades going to one, and really that to me is inflation globally, right? And the idea right now is Japan wouldn't hike because Japan is magic and there's no inflation in Japan. It's been stunning, but maybe I think the last time we talked, I find it unbelievable that Japan could have such little inflation. They import everything. And last week, Tokyo CPI might have marked the top. It was hot.
Yeah.
In dollar yen, and it's starting to come down now. And Barclays you basically just put a Fibonacci on that 9-week move, and you get somewhere around 122, 123, 124. And I'm tempted by that idea because I just don't understand how Japan can avoid this. And if treasuries keep doing what they're doing, you know, the dollar could cool off a little bit as well, maybe not against the rest of the field, but on that front, just on you know, safe haven flows. So, you know, there's that one trade is very interesting. And, you know, we have PPI today, food inflation coming in really hot yesterday, and CPI as well. And a
Well,
lot
that's
more
not going to change for years.
in the pipeline. And that is, it's scary, right? That's the kind of inflation. People moan about gas prices, probably not that big of a share of the wallet. Whereas food hits everybody. And I mean, in the emerging world, it's devastating. And so you get a little bit of instability out of that as well. And yeah, like you said, it's not looking good for.
And you were always worried about China, and we talked before the Olympics that you know, that COVID was going to spread from the Olympic event, and we weren't sure how severe lockdowns would be, but people are actually committing suicide.
It's all. I mean, it's and it was interesting this week. So the World Health Organization, which sort of everyone was accusing of being in China's pocket at the dawn of the pandemic and for a long time, comes out and says, listen, this strategy is nuts. You got to shift. It's not going to work. Which was odd, right? And initially I thought, well, maybe China sort of prompted that and said, you know, give us a bit of cover for getting away from this, because this is obviously a failing strategy. You can't keep this up forever. But then China sort of censored it, like they took it right offline. And then Biden came out the exact same day and talked about lifting tariffs on China. And I wonder if that's a bit of a carrot and stick strategy. So you start to hit China with criticism, because nobody globally wants this to continue, and then offer them, okay, we'll lift some tariffs, because tariffs should lower prices as well. So it makes sense for everyone right now. So, you know, that would be positive. I mean, that's probably the number one headline that you want to look for the rest of the year, is China abandoning
Reopening.
And you know, it's probably not going to happen all at once. And that might, you know, I don't know the health implications of that, but you wouldn't want 1 billion people to get COVID all at once, who haven't been exposed to it. But, you know, I think if they get off of that, you price in whatever 3-6 months of sort of pain in China as they get through COVID. And then I think you look past that almost instantly to the other side where they're open. And,
you know, I interview,
better.
you know, I'm glad you brought it up, because, you know, I interview, you of course are the smartest guy I ever interview. Okay. But I interview some guys with pretty good insight, and he likes this as a contrarian trade, FXI. And also, isn't the difference that in China they're easing, right?
That's it. They have some levers to pull on.
Yeah, they're easing and we're tightening.
They have a lot of levers to pull on there in terms of, so they're talking about infrastructure stimulus. Things are real cheap there. I mean, we talk about S&P 500, it's still 17 times earnings, and I expect that to come down. The earnings.
What are earnings on this?
Yeah, I'm not actually sure what it is, but it's got to be half of that. And I think if you get into like consumer discretionary, I feel that ETF is.
Yeah, FXI.
You know, and I'm thinking about, okay, where do you want to be? Is it consumer discretionary, or maybe it's just global commodities, right? Maybe the oil is the trade on China reopening. So, you know, I think there's a few different ways to look at it, but as a trader, I think that now is the time to think about, okay, what's my trade when China reopens, because it's coming. And I think you want to have a game plan before you get to it. A shares, the other one on China. So
Shanghai, I know someone that like Shanghai. Yeah. You know, these silver shares have gotten awful cheap. Are you tempted yet?
You know, so I think in the big picture right now, everyone's arguing about, okay, what's the Fed or what inflation is going to be? Are we going to go to 4% now? Do we have to over tighten? And I think a better question is, are we headed for a new inflationary regime of high inflation for the decade? And, you know, Christine Lagarde's speech yesterday, I thought was monumental. She came out and said, listen, enough of this already. We got to hike rates. And then Schnabel, who's a governing council member at the ECB, kind of went into more detail with basically the same speech. And it wasn't, I think the market's looking at it as, we just got to hike to, you know, a little bit. What they were outlining was, we got to get on top of this. You know, here's our mandate is inflation, and we need to keep going up. because we're suddenly worried about inflation. And she said, well, there's the green transition, right? We're going to be investing a ton of money in that. Energy prices are insane. That's all inflationary for more than the next year or two. You have a war that's inflationary. You have deglobalization in some sense that's going to be inflationary. So what if we're just in a regime now of 3 to 4% inflation, and central banks are kind of always fighting this battle? And I think in that kind of situation, you have to think about precious metals. Commodities in general would be a good spot. I don't know if this is going to have to tighten into a recession or just slower growth. Nominal growth is still very good, when you have to back out the inflation to get to real growth. But and I think in that dynamic, gold is sort of morphed into, well, it's an inflation hedge, it's a deflation hedge. No one really knows what it is. But with money sort of losing value, bonds losing value, turmoil, inflation, emerging market currencies, you're going to have instability like we talked about with food and inflation.
Yeah.
For them, gold then becomes pretty attractive, right? And those could be huge flows into precious metals. And I'm increasingly sympathetic to the idea that gold, that precious metals could be a big winner. I mean, you've seen gold, like we talk, it's down, right? And gold's like say $200 off the highs, not even 150.
Look at this decline in the blue chip golds. Miners.
That's crazy. I mean, I think that's a lot of that's cost inflation. It's a lot. It's very energy intensive to run a mine, but that seems crazy to me.
But I mean, most of these miners are making money over $1,000 gold.
Oh, great! Yeah, I mean, no. If you're all in, sustaining cost should not be above $1,200.
A lot of them don't have a lot of debt anymore like they used to.
They've really
last few cycles. They've cleaned it up.
And so you set up for
ball coming here.
Gold's down $150. Gold's down $150, but the dollar's up, dramatically. So if you look at gold priced in anything else, it's still pretty good. Yeah. And I like the miners, like there's royalties, like Franco-Nevada or something. They don't have that cost inflation exposure. They just get the money side. I think a lot of those royalty companies are investing. Yeah, the miners, mining in general, mining services. I'm kind of looking at a lot of the services for these because they can pass on that cost inflation.
A lot of people are playing the ags, another thing that the Fed, I don't think, can solve. I mean, you talk about we could cause demand destruction. I've talked to some grain people. They say, yeah, it happens. I saw it in under Volcker. Corn was the last thing to cave. Okay, but they, because it's not economically sensitive.
Yeah, it seems to me crazy. I mean, even, if you go back to the 70s, the world is so much richer than it was then. So, food, you still have lots of parts of the world that are extremely poor. But if you look at China now compared to the 1970s, I mean, China's not going to starve no matter what the price of grains are. So that demand is insensitive.
They stockpiled. They're ready for this.
Right. And I mean, the whole world is rich. So I feel that, it causes turmoil, it causes a lot of pain, but demand destruction in ag, that to me seems, you talk to the guys who know, but there's some substitution. You can do a bit, but that to me seems crazy that there's even a price for that. There's like no lid on it as far as I'm concerned.
Yeah, it's like the perfect storm. And the Russians, there is some wheat moving into Russian trucks back to Russia from Ukraine. That's a big export news.
I guess the planting would be, ag isn't.
They're planting in the flak jackets.
Yeah, see that. that can be. And getting fertilizer. What's the yield loss just on fertilizer loss?
Right. And US, if you follow grains, we're only at half. We have half the progress in planting that we had last year. Not as many guys are planting.
And fertilizer is a natural gas trade, and we had natural gas at $9 last week. So
yeah, natural gas is well. Remember, we talked about the arbitrage between the U.S. price and European price
coming in
of nat gas, and their new plan is we're going to be the reliable supplier.
It's unbelievably good if you're an LNG
producer.
I think there's
it was not so good for the consumer.
has to come down here because there's so much more supply in North America to tap. But again, that's why I kind of like the drilling services companies, because they've got to drill here at any price. I mean, you can make so much money fracking it with gas is $7.50 now.
Yeah.
That's
what are they waiting for?
I think probably, sometimes I read a lot of headlines
Yeah.
And then things stick with you. Sometimes you hear a lot and
right.
And you kind of filter it out. It was about 3 weeks ago now.
Come on, you get information overload to where your head feels like exploding.
You get it. And then so you're like subconsciously filtering it. And some things you kind of remember and they stick with you and you don't really know why. But one was Halliburton, which is a big oil service company.
Yeah.
And they said, we're sold out for the second half of the year. And this was 3 weeks ago. And they're huge. So you gotta think, all these servicers and all these drillers, they're
busy.
They've been busy. You can't get steel pipe. You can't get workers.
Here we go. So all the supply chain stuff.
Exactly. And so I think they're drilling as much as they can, but if you call someone up and say
slow,
they can't drill.
And they can't put in solar projects because there's a big deal about the panels going through the courts. So no one could move on that stuff either.
I believe the trade of the decade is energy. All aspects of energy. And we need to solve for reliable energy, cheapness of energy, green energy, and security of energy. And that's going to take all types of energy. And I think we're good. We've gone from a time where we take energy for granted, electricity, to a time when it's not so much taken for granted. And it's a gigantic input in a lot of industries and people's wallets. And I think I've
thought of getting a generator. We're going to have lots of power outages in Southern California.
And you see it there, right? California, Europe. I think California announced they're going to keep a nuclear plant online last week, one that had been planned to be sunset maybe 2026.
Yeah.
And you see the problem with a lot of this, you need to plan many years out. And so, what does everyone do? I mean, Europe sort of gung-ho to stick to green, but I think Asia, maybe they just say, you know what, we'll just burn coal here. We can't figure out where this is going. People will build nuclear, but that's, like you say, a 10-year project. Solar, wind, it works, but you need those backups. And then, fuel, right? So natural gas is hugely in demand, and oil. So there's going to be a ton of investment going into this. And a lot of that comes back to copper going into a lot of the inputs for green energy, but nobody's mining. And copper is sort of cracked here, right? So you have, I think you almost have to set up for the next trade now. So say we don't know if there's going to be a recession, how bad this economy gets. It's not looking great now. But if
up here, I was talking 3.25 for copper. That's still another 70 cents.
Let's say we get there. I'm not following miners, and they're thinking about green lighting projects now that are really shovel ready. A big one in Australia is one that's sort of on the line. And they, it was almost assumed that they were going to green light this in, say, September, October.
Is Freeport in on it?
There's a company called Copper Mountain's one. It's a smaller producer.
Okay.
But it's, I think it's indicative. I think it's indicative. It's because it's a pure play sort of tier one jurisdiction company.
Right.
So it was assumed they were going to green light this, but now you've got copper prices falling and they've got cost inflation pressure on the mine. So you kind of had laid out this whole case. We'll build it for $1 billion or whatever it was going to cost.
Yeah.
And now they're sort of rerunning the numbers and saying, listen, we can't find workers. These fuel prices are going to be insane. The cost of everything's going up.
Same thing.
And we just don't have any certainty on the cost of this. And meanwhile, copper prices are falling. Their borrowing costs are going up. And so maybe they defer this project.
Yeah.
For, a year or two or whenever. But that sets up that supply shortage down the line.
Yeah.
And so the next trade is you're just going to get, and China reopens, right? China starts hammering the infrastructure again. Fiscal might loosen up everywhere again if growth hits the rocks.
So everything's going down together. Copper, Dr. Copper, all bull markets are roofed in copper, and the S&Ps and Nasdaq are going down. And I would expect them both to bottom around the same time. And it'll be maybe a growth scare, maybe the next phase of the stock market, and I do think we could get short-term rallies, will be the downgrade of future earnings, because the comps are going to be tougher.
And margin
yeah.
compression.
Yeah. So maybe that's the last part of bringing PEs down, is people get discouraged with future earnings, and that puts in the low.
And I think, growth is, you've seen a few of these cycles. You go from this gun.
I've seen 100 of them.
You go from loving growth and tech, and you price to sales or whatever you want to price to total addressable market. And then eventually you get back to price to earnings or price to free cash flow. And so the market is going to eventually price everything on real earnings. So that means companies have to produce real earnings. So then you get sort of layoffs, you get cost cuts, a little bit less CapEx. And the market starts to shift to those companies that are producing cash flow. And that's where the kind of the money flows. And we're seeing a little bit of that into value, although everything's falling right now. The next cycle isn't going to be led by tech. I think it will be led by, it might be industrials, it might be mining.
Things really, that hurt when they fall on your foot.
They're really, really cheap already, a lot of them. But and it's not going to be, I don't think, great, because the problem when you're pricing things on free cash flow, you can't do 100 times like you did with growth stocks. You can, maybe you get to 10% free cash flow yield, and then when you get to 5, well, it's really not that attractive anymore unless the underlying goes up.
So maybe it needs time for this to play out, Adam. Everything I talked about, how everything always seems to take longer than we think it's going to do. Usually you have to be patient for an outcome. So maybe we go all the way until July or the fall for all these negatives and pullbacks and liquidity issues to dry up for the next, and maybe by then the Fed is flipping. And that's when it happens, really.
I'm on
steroids.
To me, that's almost the best case scenario. The worst case is this inflation sticks around. We start to realize the Fed's never flipping, might go to 4%. Inflation becomes embedded, and then the Fed starts talking about going even higher. And I think
that's 2,500 S&Ps.
It really. And then just flat from there. I think everyone's sort of looking for this dip to buy and assuming it's going to go back up. But I think that mentality has to be erased. It has to be like, listen, it's never going back. Netflix is never going back to 300. And that and everything has to get to a bottom at this point, because the psychology is now this, the broken bubble psychology. And the other thing is leverage. You mentioned it. You don't see enough talk about how much of everything was really leverage. I mean, you could borrow money from your broker at 1% and invest in anything that the universe of things you can invest in at 0% or 1% borrowing and make a positive return is like in unlimited. If you have to borrow though at 4 or 5%, it's you actually you're in a much tougher spot. And so as you go from 0% to 5%, you have to decide when you want to get out, right? You have to take off this leverage. If you're leveraged 3 to 1, you have to decide, okay, I don't want to be paying 5%. So now I got to take down the leverage. And do you want to be the first guy out the door or the last guy out the door? And I think we're seeing people now saying, listen, I gotta get down to no leverage. And that takes so much money out of the system. I mean, we've seen in bonds, anybody who owned bonds was leveraged.
They're out.
And like layers of leverage, because everything was lent back out.
You always said the biggest bubble was the bond market. And, and I want to ask you something here, because maybe we're going to have a little bit of a counter trend move in the bond market short, or do you think actually there's some value here? We're trying to turn higher on the month.
Well, I wonder about the front end, right? So you're 258 at twos.
Yeah.
If you get bearish and you don't like anything, I mean, 258 for 2 years, that's pretty good. I mean, it's you're not getting rich, but you generate a bit of positive return. The long end, I agree with what you're saying. It maybe has gone too far. It's interesting now. A lot of the deleveraging might have happened. right?
Because a lot of people, Adam, have been, making money, and they even coined a term for it, the great steepening.
Yeah.
And that seems to be interrupted right now, the great steepening, and it became a fashionable thing.
Yeah, we kind of priced this cycle sort of like every other cycle, right? Like the long end would move up, the Fed would bring the front end back down. And it inverted, and people didn't really believe that things were that bad. Consumers are in pretty good shape. So, I don't know about the curve trades. I don't want to overthink that, but what I worry about is this sort of decade of high inflation. Right now, everyone's looking at 3% 30s and saying, listen, that's about it.
Yeah.
But what if we get to 5-6% 30s? I mean, that's a huge amount of pain. And right down through the system, right? Like, what's a 30-year fixed in the US with a 6% treasury, 30-year bond? I mean, it's like 8.5.
Yeah.
And I'm a big housing bull, but the 8.5, get out of here.
Think it's popping?
I think it's popping in Canada. I think it's got more legs in the US, but again, that's predicated on 5%. There's no supply. And I guess that's the other thing for this decade. I'm thinking a lot about the long-term future here is it's undersupply, right? Oil's holding up because there's no supply. It's remarkable how much oil.
It's the everything shortage.
Well, that's it. The housing shortage, metal shortage, every
labor shortage.
Because there hasn't been, all the investments gone to tech.
Revenue shortage. Let's give each other a raise today.
So and again, if we get this recession scare, there's going to be even less investment in raw materials, and so huge shortages of all these things.
Yeah.
And that is a crazy stagflationary impulse.
Yeah.
So if this all sort of unfolds, kind of how the market's indicating now, we're in for a real tough decade. And where do you hide? Where there's not a lot of great places aside from commodities, and in the FX market, the dollar still.
Adam, I mean, let's wrap with that. Let's talk about how the parity guys ought to be coming out of the closet now, right?
Get out of here. Okay, I used to see these models on European growth. Okay, what's your, the different models come over assuming this and that. If your model for European growth for the next 5 years is anything above 0, you're wrong. There is no growth coming. I mean, this war is devastating. The politicians have no idea. They're so smug that they don't care. I mean, and I see a bit of a change in tone, like Hungary saying, listen, enough already. We got to, feed and heat and power our own people. And
I have an idea.
But the European leaders do not care. They're going to sink their own economy. And
they need a concert. They need a concert, Adam, with Mario Draghi playing lead guitar. I'm telling you, Europe would come together. Forex Live, Mario Draghi playing a Gibson. Nice. All right, so I think Europe would all pull together.
There's no growth in Europe. There's no growth in Europe, and I think you're seeing that spill over in the UK as well.
Oh gosh, the cable's been worse because Euro pound's been working real well. So that shows you how bad cable is when this is going up.
And they have to get back, like they have fiscal rules in the Eurozone, and it's like the sword of Damocles. I don't think they're going to do it for 2023. We have limits on deficits, right?
Yeah.
So 3%, it sort of slides around a little bit, and they waived it for the pandemic. But now you're going to have a terrible economy. They're going to be subsidizing energy like crazy, and they're going to have to get back to these deficit targets in an inflationary environment. And in an inflationary environment, what's the Italian 10-year yield, or the Spanish 10-year yield, or the Greek 10-year yield? I mean, they're going to be borrowing it at 6%, 8% in no time. The ECB is going to have a mess on their hands trying to fight that.
So you're telling me you're not bullish Euro?
Oh, man. There's nothing.
There's no reason. Okay, well then let me find a couple where maybe you might find a reason. Okay, here's Aussie. All right, so you like commodities, right?
Yeah, I do.
You think China might pull out of this and reopen someday. So what about the Aussie in this range? Really, when you look at the long term since COVID, it's held up the best. Euro's already taken out its COVID low, right?
Not a great move this month, though.
Yeah, but not this month, but commodities are coming off, right? So maybe 66 cents or so, another 100, 200 pips. Would you look at long Aussie? And you know what's even more convincing? And I thought about this. Why do I have to take the tough trade? Canada is acting okay. Maybe it goes to 132, but we're not even close, just like the Aussie, to the highs during COVID, right?
Listen, the Canadian housing bubble is busting. I wish I'll share with you the chart. I mean, the Canada compared to the US housing prices, like double. It's I don't know, I think I can pull up the chart quick enough, but it is insane and it's coming undone. So the problem for CAT, you're right, there is going to be a trade in Canadian commodities. It's going to be a pretty good trade surplus going for a lot of years coming.
Yeah.
And investment will start to come, probably in new oil even. But an LNG might actually happen in this country, but the housing is going to crash and the consumer might be hurt pretty bad by it. And we're at it right now. And I don't think you can buy the loonie until 135, 137.
Oh, that much left in it up there. Okay.
And
I'm glad I brought it up. That it gives me pause.
And I'm normally a pretty big CAD bull, but and I like the setup for a lot of Canadian companies and any kind of resource companies. But and again, they make a ton of money selling in US dollars when your costs are all in CAD. So there's sort of a lot of torque in that sort of mine.
Okay, well, Adam, I always enjoy talking to you, and people could follow you on Twitter at FX_button or at Forex Live and read a lot of Adam's stuff here. They have a lot of information. It's a great site, and it's not as busy as some of the others that try to do what these guys have done. And lots of great articles, and check out their website. Go to forexlive.com. And Adam, let's end it with a takeaway. So, we talk every 30 days. Biggest event in the next 30 days that no one sees coming.
Biggest event in the next 30 days that nobody sees coming.
Except I mean,
watch China. And 30 days seems a little early for that.
Yeah. You think we're getting closer to that paradigm?
I mean, at some point, good sense has to take over. Yeah. Honestly, I think we're maybe, if we get a little bit more bad inflation news, on a real crash day. I mean, these 2%, 1% down days are rough, but I don't rule out 7% down days.
Yeah, because the VIX isn't doing much on these. It's orderly. So you still think, okay, so the biggest surprise is people are going, well, the market's down, but the VIX isn't really doing anything. So maybe it's not bad. Maybe it is a correction. And then there's some type of, black swan or something that's exacerbated. It could be
like, maybe you take away
like
the Fed
tactical nuke.
You take away the Fed put. You say, I think there's still that belief the Fed will come to the rescue.
Yeah. No.
And they might come out and say, you know what, we're talking 50-50 now, but we might have to keep going 50 and we might have to over tighten here. Yeah, and so we're not so worried about growth. They're starting to say, this week, it's almost coordinated. Well, we might need to lose jobs.
Yeah.
And that's okay. That seems pretty
lose jobs with a labor shortage.
And they'll say, listen, we'll hike into a recession if we need.
You could say the word. It starts with D. Anyway, Dale Pinkert, that's it. And we covered energy, and you've got great energy. Yeah. And I really appreciate you sharing that and your insights with us. And it's always great to talk to you. And I learn from you every time we do this. So thank you for being here at TradeGATEHub.
Likewise, have a good week, everyone. And great. I guess we're almost into the weekend here, but
feels like Friday to me, buddy. All right, Adam Button, everyone. Hope you enjoyed it. And thanks again, Adam. Really appreciate your insights. And we should be maybe we have a crash day next week. If we can't turn it, that close looks pretty ugly on a weekly candle. So thanks, Adam, again. Good hunting, buddy.
Take care, Dale.
My trading warrior brother, Adam Button. Adios, everyone. Don't just count your oil barrels, count your blessings. And I'll see you next week. Adios.